In this video, we're going to talk about what is infinite banking and how does it work.
We're going to break this presentation into 4 different parts. We're going to look at the current situation, how we got here. We're going to talk about what is infinite banking and how does it work. And thirdly, we're going to share a real life example so you can apply this yourself. This is the current situation. If you take the Fortune 500, this is from the magazine that started in 1955. You take the top 500 companies worldwide, only 65 remain. Now, according to Matt Sims, the survival rate of businesses decrease every year. Not too bad for the first year, 80% stick around. But look at year 10, only 30% are still here. And the stats are even worse for the solo entrepreneur, consultants, coaches. 66% of solo entrepreneurs will fail within the first year. Are we becoming better savers or worse? Now look back in 1980. For every dollar earned, 80 cents was going out. Lots has changed since then. And unfortunately, for every dollar earned here in 2022, $1.71 is going out. This means we are spending way more than we're actually making. And unfortunately, for 38% of the Canadians out there, this debt is increasing year after year, according to the Canadian Payroll Association. And 53% of Canadians are on the brink of insolvency, according to an MNP survey. And this is not just a personal issue. No, this is a federal issue. Look at this current debt by our government. I can't even say that number. That number is huge. And when I look at this, the amount of spending that is going on from our government and governments around the world, countries are over-leveraged, companies are over-leveraged, and people are over-leveraged. Do you think that means our taxes are going to increase or decrease in the future? And if we call a spade right now, and we needed to pay off that debt, your share is $57,500. And that was back in 2021. So we all know it's only increased since then. This is a savings issue. This stat surprises me. Every time I see this stat, I can't believe it. But according to the Canadian Payroll Association, 34% of Canadians could not come up with $2,000 in a month for emergency expenses. This is shocking. Now, who's underwater? According to Benefits Canada, 91% of Canadians will never reach or maintain financial independence. The problem's not education anymore. It's where we're getting our education. The majority are getting their financial guidance and advice from the bank. And think about it. Where are the bank's biggest profits? Where are they making the most money? Well, if you're looking at this picture, you can see it. It's from credit cards, lines of credit, mortgages. They are getting it from debt. What about the traditional financial advice? You go to an advisor and they say, hey, put 10% of away into mutual funds and stocks, play the market. Eventually you'll reach $1 million and you can live off that. One of the things missing from the wealth equation is the fact that money is not bar charts and graphs and math. It's emotion, and it's extremely emotional. A lot of people think they're just going to throw money into the market and make money. Even the most experienced financial advisor and investor is still very emotional and biased. And I'm going to share with you a dirty little secret in the financial industry. More often than not, the average rate of return is often reported, not the actual rate of return. If you had $1 million that you're supposed to bet up to, and you lived off that, you took 100,000 out every year, how long would that money last? Well, if you got the average rate of return, the money would last a long time. But if you got the actual rate of return and put that $1 million into the market, it took 100,000 out, your money is gone for years. If you want to become financial independent, you have to stop taking average advice for average people. There are so many things trying to take your money away from you. And the biggest culprit, the biggest thief is taxes. Taxes and debt are your 2 major villains from you and your family getting to that happy ending, to getting towards that financial independence. Do you have a strategy on how to defeat these villains? What if there's a better way? And that leads us to the infinite banking concept. What is infinite banking and how does it work? The infinite banking concept, or IBC, is the process by which one becomes their own banker, as taught by the late Nelson Nash. This is taken directly from the Nelson Nash Institute. There is less than 50 acknowledged infinite banking practitioners here in Canada, and the majority of the great ones team together to form the group of the IBCanada Group, where we represent you. We are a group of independent financial professionals that are also acknowledged infinite banking practitioners. When I look at infinite banking, I look at it as a way to recapture the interest that you normally would have given away to banks. And it's also a way to have that money that normally would have left you continue to grow. Let me show you exactly what I mean. We're going to use an example of buying a car. Now, everyone in Canada almost buys a car, right? There's really three ways that we do this. We can either buy it with straight up cash, we can finance it or lease it. The majority will finance it. They'll borrow the money generally from a bank. Let's say, for an example, it's a $40,000 car. You eventually pay that $40,000 back plus interest. Now, is that the only car you ever get? Well, if you're like most Canadians, no. You repeat this process. You repeat it 2, 3, up to 8 times, maybe more. Now, I want you to think about this. The bank was nice enough to give you the money the first time. But where does the bank get the money for the second, third, fourth, eighth time?
Hey, if you could smash that like button and subscribe, and please share this with those that want to do even better, those that you care about, that want to keep their hard-earned money instead of giving away to taxes, fees, losses in the unknown. We are here to help.
But where does the bank get the money for the second, third, fourth, eighth time? They get it from you. This is a money-making process. Instead of relying on the banks, you become your own bank. So when I bought my first car, I did all the math and I calculated the best way to buy a car, as long as I was buying more than one, was to buy with cash. What I did not take into account was the opportunity cost. So when I bought my truck, I gave the dealership $40,000, and that $40,000 left me. Could have been earning interest, but no longer, because that money left me. This is why we teach people how to become their own banker, where you act like the saver at first, and then you borrow against yourself so you can still get that capital growth. That $40,000 continues to grow and grow. And as you can see, over the long haul, there's a huge difference between the banker and the debtor and the saver. Become your own banker. When I talk about diversified portfolio, folks, I'm not talking about owning a bunch of mutual funds. No, this is being truly diversified, having several different ways of wealth creation. And if you look at this diversified portfolio, that includes your business or your source of employment, real estate, investing and saving, living benefits, whole life. This is what we're going to talk about, or becoming your own bank. And of course, there's the alternatives out there. Where do you think you're going to make the majority of your wealth from? I hope you look at this and you realize that you are your number one asset. All right. It's your employment, it's your business. And when you realize you are your number one asset, you need to start acting like it. Now, based out of all these diversified portfolios, these different ways of creating wealth, there's only one that doesn't rely on the market. It doesn't rely on the economy. And that's becoming your own bank using a properly structured dividend paying whole life policy. Once you're invested in this, it grows very tax efficiently and never goes down. Not like the market, not like ULs. Vested continues to grow. Now I'm going to show you what a properly structured policy looks like. In fact, this is my very own policy. There's really two portions. There's the investing portion, and then there's the portion that you can use while you're living. Where the good people at IBCanada do this different than almost every other financial professional out there. Look, only 10% of the financial professionals out there talk about whole life. You can't get this at banks. And then only 10% of the 10% design these policies so they're so efficient for you. I broke this into a whole 100,000 whole life, where that comes at an annual premium of just shy of $2,000. I added a term rider that comes at an annual premium of less than $1,000, and that's for 10 years of $1 million term rider. That increases the amount that you can put in the deposit option. This is the portion that you can use while you're living that grows very tax efficiently, that's vested, and you have access to it anytime you want. And this allows me to put in $44,194 for the next 20 years. Pretty cool stuff, right? Cost of insurance is low. The amount that you can put in the deposit option is pretty high. So what we do is have that policy grow, and we have the ability to borrow against it. For my policy that I'm using, it's prime plus 2. Now, I don't get that interest back, but the original money continues to grow. We use $50,000 to help with our landscaping in our backyard. So that $50,000, I borrow against it, but it still continues to grow. And then I pay myself back like the bank, and then have more money down the road. It's really cool. This is true compound growth, and this is what you get with a properly structured dividend and whole life policy. The major problem with this is it takes time. If you understand the rule of 72, and that simply states the amount of interest that you get on your money divided 72 is usually roughly the amount of time it takes for your money to double. From your initial investment, you're looking from 10 to 12 years for your initial investment to double. So a lot of people don't see the growth right away. They get frustrated. They find it very boring, but eventually they see the growth and life becomes very exciting. It's our vision to help you get true, tax efficient, and uninterrupted compound growth. If you want to learn more, reach out to an infinite banking authorized practitioner, and you can find the creme of the creme at the IBCanada Group.ca.